Assumable loans are both a great opportunity and a source of great peril if not done properly. And there's been a lot of people who've been stuck doing them incorrectly. But more importantly, there are a lot of veterans in particular who are missing the opportunity that's sitting in front of them today. I have a chance to talk again to a couple people who are really, I think, experts in this field. Britney Galvin is located in Phoenix, Arizona, but also does business in California, and is an expert on, in particular, not just assumable loans, but VA assumptions. Britney, how are you doing today?
I'm doing well, Bill. Thank you.
Great. And so I guess behind you we have what the paid staff, or who we have behind you?
Yes, my partner, Andrew.
The beautiful assistant.
No, Andrew, I don't think that's the beautiful assistant. But anyhow, so let's talk about assumptions. I think are both a tremendous opportunity and a pitfall. We'll get to the pitfalls, but let's talk about what's the opportunity of assumable loans that's being missed by most people today that you're able to fill that void.
I think for what we find is that a lot of people are priced out of certain neighborhoods or certain communities because of interest rates currently. And a lot of the frustration that we were getting from our traditional buyers was, hey, my friend, my brother, my sister was able to buy this price in this neighborhood a few years ago, and their mortgage payment is $2,500 a month. And if I want to buy in that same neighborhood now, I'm going to be paying $4,500 a month for the same property. And so what we found is it's created an opportunity for people to take over rates that are much lower than are probably ever going to exist in today's market or in the future, and afford neighborhoods that might be out of touch in current interest rate environment.
So that's the buy side, where people have a chance to buy into a property where there already is a loan at a below market rate and benefit from some of that as well. Then the flip side, we also have the opportunity for sellers. Talk about, sellers who have an assumable loan feel like, well, I don't want to move out of my property because I have this great mortgage at 2.75. I have to buy, I have to pay more if I'm going to, sell the house and rent. I don't get any benefit from that. How do you unlock value for those holders of assumable loans, which are oftentimes veterans?
Yeah, there's a couple different ways. So I think the first thing that needs to be understood broadly is what types of loan products are assumable. There's three that we commonly deal with, really two. USDA loans are fully assumable, and no matter what the loan servicer says, they are assumable. Because just know that the loan servicer is incentivized to get that loan off the books because it's at a below market rate. In fact, when you factor for inflation, often it's a negative interest rate.
So hold on, are you saying the loan servicer might mislead the consumer just to make excess profit at the consumer's expense?
Yes, shocker.
What?
Hard to believe in today's market that that's what takes place, but yes, it does take place, and we get that a lot. In fact, when we're both on the buy and sell side, when a seller's like, well, I talked to somebody and they said that, well, we can't let our loan be assumed because of this or that, and
a very common misconception.
And the truth is that is completely not true. It's written into the guidelines, and that's actually illegal. And so,
and if we go forward, just to explain for people watching, that's why you never hear about this in real estate industry news, because the real estate industry news gets advertisements from lenders making new loans. They don't get paid from lenders who have loans on the books, where somebody's entitled to have that low rate assumed for their benefit, but it doesn't help the new lender make any money. So nobody writes about this, nobody talks about this, nobody trains about this, and that's where you guys step in and offer that expertise to help that seller unlock the value.
And that's where also, like, we have a lot of clients who will call us and be like, hey, well, why didn't my lender tell me about this? Well, your lender, and a lot of times I try not to assume malice as the intent, right? It's just ignorance. But the lender doesn't know, or the lender knows and they don't want to do it because they don't make any money. Right, because there's no
not new financing.
It's not new financing, so there's no fees associated with the underwriting process.
So USDA is one of them. VA is another assumable product, and FHA is also assumable. So those three. So Andrew and I don't commonly come across a ton of USDA, specifically here in Phoenix. So we are primarily focusing on both VA and FHA, kind of dependent on the avatar of our clients. So we do work with both primary home buyers and investment buyers. So depending on which bucket you would fall into, that's how him and I are targeting whether we're, gonna approach VA or FHA as an option.
And same thing with the sales side of things, right? It's a little bit easier with FHA. If you're a primary homeowner who's selling to move to a different part of town, or maybe you getting transferred for work. FHA loans are 100% assumable, and there's no entitlement that needs to be surrendered when you give up your loan on your FHA product. You could go buy another house FHA tomorrow, and there's not going to be any type of repercussion or possible drawback for you in doing that. We work with a lot of veterans as well, and that's where I think education is really important, because there's a lot of misinformation out there about what veterans entitlement is, how it works, functions, what that total number looks like, and there's a lot of nuance there. And so sometimes we'll talk to a veteran who needs to sell their home, and they'll be like, well, I can't give up my entitlement. And then when we actually sit down and run through the numbers, they have enough bonus entitlement, equity, and entitlement remaining to buy the house that they want zero down, even if they were to surrender a portion of their entitlement. So our whole thing is just education and making sure that ultimately, what for sellers, whether it's primarily for veterans, because there's really no drawback for an FHA homeowner to let someone assume, just make sure that they understand what they're giving up, for how long, and what it looks like for them going forward.
So speaking, kind of pivoting back into the benefits, right? To, for instance, Bill, a seller, that's actually one of the ways in which Andrew and I got into these assumptions, is that I had a listing that I had no idea was assumable. And so once we did find that out, I had a set of vets that moved out of Phoenix. They were ordered across the country. And the cool thing was the increased marketability. Once we found out that they were able to offer, a 2.87% interest rate to, for instance, either a veteran or a non-veteran, that was huge, increased marketability to their home. We ended up selling first weekend on market over list price. So that there, I think, is also a huge benefit, right?
In a neighborhood that does not typically perform in that way.
Yep.
Well, and so I think if you think of a mortgage if the mortgage is close to the sales price of the property, a mortgage at 3% is about 3.5% below the market, meaning the owner the first year is going to save about 3%. And so it's worth, I don't know the exact numbers, but it could be worth 5-6% or more to the seller or the buyer, or in combination. Why give that money to the bank? And for those of us I'm a little older than you guys, I think, I grew up, the bank was the nice institution that was really committed to the local community. That's not the case anymore. These banks are, I have a podcast, big evil corporations. Chase Bank, will frisk you in order to open a checking account, but they were literally financing Jeffrey Epstein's child trafficking ring. And Wells Fargo has literally been fined millions of dollars for cheating customers. And these banks take your tax dollars, and instead of providing services to taxpayers, are making money. They're not going to tell you to look for assumable loans. Now, I would think that if I had a mortgage and I thought it might be a USDA or a VA loan, or otherwise might be assumable of an FHA loan, first step I think would be reach out to you guys and find out, is assumable. Can you tell somebody if they have their mortgage statement, maybe they don't have the original note, can't find it, or what do you guys do to help somebody who might have a mortgage, they're not sure, but they want to find out if it's assumable or not?
Yeah. So the first thing you need to know is if you finance your home VA or FHA or USDA, it is assumable. There's no circumstance that it's not. Even if it has a balloon payment of some kind, like every once in a while, very, very not as commonly, we'll run into somebody who may be financed with some type of arm or balloon, and it's still fully assumable even with those terms. And so, yes, reach out to us. We're more than happy to walk you through. But if you look at your mortgage statement and it's FHA or VA, or if you look at your tax records, those are 100% assumable products, no matter what anybody tells you.
And so it seems to me that you have a firm number in mind. If I have a mortgage that's close to the sales price in a marketable area, at 3% in a market where the rates are 6.5% or so, obviously you want to market it cheaper to a buyer to get it sold. You also want to keep some of the profit in the seller's pocket. How much of an actual savings will sellers see? To me, it seems like there should be a monetary value for that loan, right? If you just bought that house, it's worth some percentage. Do you have a calculator that you use, or a rough number or formula that you use to help identify that?
It really depends on it's property to property specific, right? Because ultimately it depends on how much money are you saving in interest in the first year. So like a lot of times the math that we do, so let's just say a veteran is willing to give up their entitlement, but they want an extra $20,000 for the house, right? a lot of times when we run the numbers, let's say it's a 6.5% interest rate versus a 3% interest rate. That 3.5% delta will pay them back that $20,000 in the first year.
Year one.
In the first year. And when you amortize that over 25 years, it's
Right.
hundreds and hundreds of thousands of dollars in savings.
That's more than you guys charge for your commission to sell the property, right?
Yes, 100%. Well, there's a lot of benefits here. So the cool thing about this and why this is so beneficial to our sellers is, let's say that there's a buyer that comes along who's super like committed to buying the property, really wants that low interest debt on their books, and they're willing to spend $40,000-$50,000 over what the market price for that home is. There's no appraisal when you assume a loan. So there's no one to say you can't make as much money on the sale of your home, or there's no one that says that, hey, they have to bring in a certain amount of cash or anything like that. And ultimately, there's ways for people to get secondary financing on these properties as well, so they don't have to come in with as much cash out of pocket. But typically what we have is people who, for example, if you're a veteran, and we run into this a lot because there's a lot of tract builders in Phoenix. And so they buy a property on a VA loan, and the community is still largely under construction when they decide they get orders to move, or they decide that they want to have a family and they need some more bedrooms. But whatever the change in life circumstance ends up being, ultimately they have to compete now with a new builder who's offering all kinds of incentives for you to buy the home that hasn't been lived in yet. Whether it's rate buy downs to well below market rate,
Closing costs,
incentives, refrigerator, washer, dryer, like that kind of stuff, right? And what we find is that people with non-assumable loans really struggle because there's not much of a secondary market in those tract built communities until 5, 10, 15 years down the road. But when you have an assumable loan product, what we're finding is, while the neighbor might have to short sell to get out of the neighborhood because they can't compete with the builder, that low interest rate that you locked in being fully assumable, your yard being done, things like that, all of a sudden there's all this extra value. For example, we have a listing right now that's under contract where the neighbor, literally the house next door, short sold for $50,000 less than what we're going to sell for, because we have an assumable loan and a client that's willing to give up their entitlement, and they're going to walk away with money versus having to pay to get out of that house.
Wow. So that's real cash money in their pocket.
Yes. Yeah. And frankly, like for a lot of and it's different for everybody. There's not a one size fits all, but for a lot of, especially our veteran sellers, they're getting so much equity out of the sale of their property that it makes more sense for them to get into a conventional loan product versus a VA product on their next house anyways. But again, it's always specific to the individual person, because our primary focus, especially if it's a veteran, is making sure that the veterans' benefits are protected because they earned those.
Yeah, and so it's just interesting to me. I know I introduced you to a group that I work with that services veterans, and I feel like there are companies that, purport to serve them, really just money-making ventures. But here, there's no way you can't unlock the value for the veteran who has that loan. I mean, they have something that's worth, they may owe $400,000, but they have something that's worth maybe $12,000 more than that.
Oh, absolutely.
And you're going to unlock that for them. And I think that's the thing that, and it just troubles me so much that even lenders who are VA lenders, all they want to do is originate new loans.
Oh, yeah.
They don't lead with this. They should be leading with this. And then, of course, if you don't own a house, of course, and you don't trade up, and you could talk about the advantages or risks of leaving the entitlement on the old property. And there's advantages and there's concerns and such. But what there isn't is a process. And that's why when I heard about you through a mutual friend, I just jumped. I said, more people need to know about this. And frankly, I don't really work with buyers, and I don't get most of my business probate. I don't get that many veteran loan listings. I don't think I've had one in the last couple of years, but I love supporting vets, and I love what you guys are doing, and I really want to support it. So now you guys are in the Phoenix area, but you also service California or San Diego area. Tell me about that.
We're in the process of expanding our business into Southern California. So we should be licensed by the end of this year.
Okay, so guys, if you're listening to this and you hear this, call them now and make them move to San Diego too, because I don't know anybody in San Diego doing this. If you know somebody in San Diego who is, please reach out to me. But until then, let's just torture them with leads and say, hey, we're vets in San Diego or in California, and I don't know, I'll handle it on referral with them. I'll work something out with them. I'm not even have to make any money on the deal. But what I want to see are people who served our country and have earned that entitlement get the
Absolutely.
full value and not just sell the property to pay off the loan and put the money in the bank's pocket. There's one group of people who don't need your money. It's banks.
So let me give you another example for veterans out there. So there's a lot of veterans who are not utilizing any of their entitlement at all. They have a conventional 20% down mortgage on their primary residence, and maybe they're already real estate investors. Like that entitlement that they have just sitting on the sideline, depending on what state you're in, it's a different amount of money. That's a weapon for you in acquiring rental properties. For example, we have non-veteran client investors who write offers on properties trying to assume veteran loans, VA loans. And that can be a little bit tougher of a process. But when a veteran assumes another veteran's loan, the entitlement is released back. So it just swaps. Right? And so you can get properties at extremely low interest rates that cash flow extremely well. And sometimes even with extremely low cash to close values where you're looking at 10, 15, sometimes even like 18, 20% cash on cash returns. And you don't even know that you have that leverage available to you. It's just sitting on the sideline. And again, to me, you've earned that. So even if your home is not financed, even if you're not using any of your current entitlement as a veteran and you want to invest in real estate, you want to buy some rental properties, this is a way for you to go utilize that benefit that you've earned and take over debt at rates that we probably won't see again in our lifetime.
And rental property works so well for veterans. I've met so many of my career who were career military, most commonly officers, because they seem to plan ahead and they seem to have more stable careers, I guess, if that's the way to look at it, even though they move around a lot. And I think that they plan ahead and think longer term. But I've met several had 5, 10 properties, one each place. They used to, they bought them when they moved into an area and kept them. They moved out. Other ones who strategically invest in other areas. So again, if you're a veteran thinking of investing in property, again, call Britney or Andrew as well and see how you can leverage your entitlement to, take advantage of the service and value that your country wants to pay you. And I know a lot of veterans will say, well, I have a negative feeling and I had a bad experience. And my best friend, unfortunately, is very distraught over how he left. Okay, but you still earned the benefit. I mean, maybe your senior officer was a real pain while you were there and you decided to leave on bad terms, but you earned the right. We have taxpayer money that's being blown on all kinds of nonsense. Let's put the money in your pocket. So Britney and Andrew, if someone wanted to reach out to you, they owned a property, they weren't sure or thought might be assumable, they want to reach out to you, or they're a veteran who wants to invest property currently today in Phoenix, hopefully in California, how's the best way for them to get in touch with you?
Yeah, by either email, phone, call, text.
Okay.
So you can reach out to us, Britney or I. We're both, it's Britney at umerealtygroup.com, UME realtygroup.com, and Andrew at umerealtygroup.com. My phone number is 503-705-9350.
Mine is 818-398-0602.
And we'll put that info in the description down below as well. And of course, if you know me, reach out to me. I'll be more glad to forward you guys on. I'm not making any money on this deal. The second I heard about this, and I know how tough life can be for veterans, especially if they're married, have kids, have to move. You have this benefit. Let's take advantage of it. Andrew and Britney, thank you so much for your time today. Look forward to continuing the conversation, and I look forward to seeing you guys expanding in California, help make that happen.
Thanks, Bill.
Thanks,
guys.